joining us to discuss some of the major takeaways is Rob Tetrault, head of the Tetrault Wealth Advisory Group, part of CG. Rob, thanks so much for joining us. What has been your high-level takeaway from what we've seen from earnings so far?
Well, one of my key takeaways, Amber, for sure, is that you'll be in Winnipeg on April 12th. You'll be hosting the CFA dinner. I'm pretty excited. I'll see you there. Please don't pretend I'm a stranger. Make sure you say hi.
I will say hi.
Good. I don't know if you do that often, but that's kind of neat, coming to Winnipeg. I like that. You asked me about key takeaways of what we're seeing in the market. So obviously, if we look at that kind of early October low, what we've seen since then, there's a lot of indicators now that are pointing that this might be for real, right? Higher for longer is what our macro analyst, Javed Mirza, calls it, HFL. And there's a lot of indicators on the technical side showing that we're holding above that 200-day moving average. The MACD, the moving average convergence divergence, is really strong. The earnings are starting on the macro side. The earnings are starting to look really good. I say really good. The inflation numbers are coming down. So two things I think, if you're asking me for my kind of overall piece, one is I think short term, it's been a big bounce back pretty quick. So you might see some pullback here, but I do think this is this is a new kind of 4-year market cycle that's taking hold, and we're kind of in the early stages of it. And I do think the next 3-4 years are going to be, we're bullish for the next 3-4 years for equities for sure.
Okay, what informs that? Because some of my takeaways from earnings have been we're likely in for some margin compression. It seems like these companies have hit their limit on how much they can increase prices. They're seeing a slowdown in consumers. They'll probably react to that by lowering prices. And I can see how that's good for the economy, but maybe creates a difficult environment for these stocks to outperform.
Well, I think you've got to look at multiples for one, historically what multiples typically trade at. And if you look at the stocks that are kind of leading the pain on the US side, which is dramatically underperforming global equities this year, the pain has largely been caused, mostly in the larger cap tech names, which has been multiple compression way more than earnings impact, right? So if we look at the multiple compression going from 25, 30, 35 to 15, 18, as long as that multiple goes back to somewhere where it's historically been, even 20, 25, for some of those larger cap names, the earnings impact isn't going to be significant in my mind. So yes, there will be margin compression, and yes, inflation is going to hit. Whether or not these companies are able to capture the price increase in inflation and pass it on to the consumer is yet to be seen, as you mentioned, Amber. But I do think multiples will come back as investor sentiment picks up. Like we've seen the VIX come down, and like volatility coming down. So I think there's a sentiment that I'm kind of sensing it, Amber, that overall there's significantly less fear today in the market. And obviously that's because the market's up, but just overall, aside from the market movement, I feel like there's less fear right now.
And actually that's confirmed by the CNN Fear Greed Index. We are away from fear and on to greed. But you mentioned something about international markets relative to the US. And that's been, I think, a conversation a lot of people have been having. And as you advise your Canadian clients, how are you? I know you talk a lot about asset allocation, but how are you talking to them about geographic diversification and whether this is the year to have kind of that home country bias?
Well, I think the home country bias would have been good over the last year or two. What do we have here? We have oil and gas, we have financials, we have some materials, but largely what's expected to outperform, I think, on a go forward, Canada's had a good run. We definitely want to own Canadian stocks. I mean, you look at what most investment firms out there are recommending for their clients in terms of Canadian asset allocation at the retail level, so not at the institutional level, but the smaller Mr. and Mrs. Smith that are probably watching this show right now, and they're likely probably much heavier in Canadian than what most institutional portfolio managers and mandates are in Canada. So maybe they're at 60% or 50 or 70% Canadian. So we think that number should be lower. Generally, our view over the last 10, 15 years, Amber, has been about a third Canadian, a third US, and a third international or non-US. but you can get most of your international exposure through some U.S. companies through ADRs and stuff like that. So to answer your question, I think we should continue to hold some Canadian, but we can't necessarily avoid or we can't look away from the international. And this year is the reason why we're approving that.